Welcome to STRAT this week. I'm Will Woodall, joined as always by Mike Rarey. Hey, Mike.
Hey, Will.
2/6, the week of February. We're going to talk about the last week Fed meeting. We're going to look at the numbers from the equity market. It was quite an interesting week. There wasn't a spike in volatility, but it was a weird week in terms of the way the market played out. We've got a lot of cool new graphs to talk through here today. So let's get started and throw up the equity returns from last week.
A pretty solid week overall for equities. You can see in the U.S. adding to their year-to-date gains. Growth stocks definitely leading the way. We have a little more detail on market leadership a little later on. But yeah, last week the big events were the Fed meeting, which markets rallied on the back of the Fed meeting. Jerome Powell sounding much different than he did at the Jackson Hole Symposium in late August. A completely different Powell. And markets are excited about a slower pace of rate hikes, a 25 basis point increase in the Fed funds rate, much slower than the supersized rate hikes we were used to last year. Right. And then we got the jobs report, and it was an absolute blowout. Over 500,000 jobs added during January, net revisions to December, November, and all of 2022, net revisions higher, very broad-based jobs gains. So the market's got a little whipsawed, right? You go from the Fed meeting thinking, all right, slower pace of rate hikes, perhaps inflation was transitory, perhaps we've defeated inflation, to then evidence that we're still in the tightest labor market in history, and if you're going to get inflation down, you got to do something about that.
Right. Yeah. And for sort of embedded in that is the no Fed pivot. Like he's never come out and said. I mean, he's been unequivocally stating that there's not going to be no interest rate cuts here. So that continued to play through, and I think people who think there's going to be a pivot, there's more solid evidence building up that we're going to have higher expectations rather than lower expectations. So Let's look under the hood, because the small caps were interesting, but this is a great chart looking at what drove or what has been driving the markets year to date, because it's sort of, I don't want to use the word crazy, but it's a little crazy at what we're seeing here.
Yeah. What we did is we took the Russell 1000 index, so the 1,000 largest stocks in the U.S. equity market, and we just said, well, what are your top 30 performing stocks year to date? And so we've listed those constituents on the page. A number of them, you look at them, and they were sort of COVID darlings. Some of them, the business models have effectively blown up since then, and they were the losers of 2022. So if we just look at these 30 constituents, thus far in 2023, they're up over 50%. As a basket, equally weighted basket. They are leading the market higher.
And so the question would be why?
Yes, great question.
Yeah.
Because if you look at 2022, in aggregate, they were down over 68%. That's when a lot of these business models blew up, like Carvana, for example. That's one of the leaders. So why are these types of stocks that performed the worst last year, were heavily shorted coming into this year, why are they the top performers this year? Our view is it's not due to fundamentals. I mean, these stocks did well in the booming liquidity environment post-COVID. Peak liquidity, 2021. Peak speculative fervor. Meme stock mania. That is not the environment we're in right now, and it's certainly not the environment we're going to be in for 2023 with a Fed funds rate of over 5% potentially. At or over 5%, and liquidity seeing the sharpest slowdown in liquidity in history. So the only narrative that makes the most sense is it's a short squeeze. Whether you were a hedge fund, whether you were any other type of trader, you were short these stocks. You made a lot of money last year. For one reason or another, you had to close out your position, and so you had to buy the stock back. And then there's clearly been a surge in options trading, which is causing options dealers to hedge their positions when they make call options, which causes them to buy the stock. So, these things happen in fits and starts. This is not a rally that we would chase. We do not think these leaders right now are going to be the leaders for the full year.
Right. I mean, you can just look at the trends on the graph here, and you talked about the COVID peak.
Yeah.
And now you're in this defined downtrend that, absent anything from a stimulus standpoint, will probably continue.
Right.
Especially as these companies have to make earnings, have to refinance their debt at much higher rates. And you've seen activists taking over or getting positions on certain companies on this list, and you've seen just poor earnings from several of them also. So it isn't something that we see as a green shoot of it's time to buy stocks.
Exactly.
So let's move to fixed income.
If you were to just look at the last week numbers, you would say, oh, nothing really happened. It was quite volatile. Coming off the Fed meeting, following that sort of dovish tone from the Fed, the European Central Bank and the Bank of England, government bond yields across the world were down on the week through Thursday. And then we got the jobs report, and a lot of them flipped right back. So just getting whipsawed, by and large, almost a nothing week. But year to date, still seeing solid gains across fixed income, particularly longer duration bonds. Like, for example, the 30-year Treasury up almost 6% year to date, and notably had a positive return last week despite all the volatility.
Yeah, I think that to just sort of tie this to the last graph we looked at, the yield curve, 210s, is, I looked this morning, is negative 80 basis points. So if things were good and stocks were okay to buy, you wouldn't see negative 80 basis points on the spreads. So just as you think about, the bond market isn't signaling things are okay. So that's why we look at both in order to determine our outlook.
Right.
So let's move to the next graph for the week, and that's the alternatives, specifically REITs and commodities.
Yeah, REITs having a decent week, gaining on or building on their gains year to date. Commodities slightly negative. If you look at the 1-year number now, commodities are only slightly positive. And you go across the board, energy actually is down 9% on a 1-year basis. So that's sort of quite different from the environment we had last year, where commodities were the only asset class with positive returns. We're definitely seeing energy prices come down. That's a good thing for inflation. That's a bad thing in terms of what it might mean for economic growth.
Right. It generally comes down as you go into recession.
Right.
Okay. So let's turn to the Fed meeting and the next graph here. We talk about the pivot and sort of the rhetoric, and I think Paul is speaking tomorrow, I believe, so we should get more. But generally speaking, what has changed, if anything, in terms of what we expect the Fed funds rate to peak out at?
So if we look at monetary policy and we think about the federal funds rate the way we do, which we think is the logical way to think about it, not only does the rate of change in the Fed funds rate matter, that arguably matters the least compared to the level and how long it's at that level. So that would be the most important thing. That's why when we look at this chart, when the blue line, which is the market expectations for the peak in the federal funds rate, that's the blue line. You can see we basically expect something around 5 is consensus. Once it goes above the long run projection, it moves into restrictive territory, meaning it will have a contractionary effect on economic growth in the future. So the level matters. We're way above the green line. It doesn't matter if the Fed stops hiking. We're way above the green line. Rates have already risen to a very restrictive level.
Right.
And then what matters is how long you're at that level. Every day you spend with the federal funds rate at a restrictive level, that is just one more day where economic momentum in theory should slow and a recession becomes more probable. So that's the first thing. Everybody getting excited about the fact that the Fed is close to being done hiking and might even cut rates by 0.5% in the back of the year. That's not keeping in mind levels and time are very important with how monetary policy works on the economy. And you can see how the market has really run away with this and sort of looked at it in the opposite way, which is when the expectations for the Fed funds rate were rising, we were seeing what we would expect, equities, foreign equities, and bonds all experiencing negative returns. Since November, expectations have peaked out. The market has coalesced around 5%. And now everything's rallying as if the Fed funds rate is actually being cut, or it's not in restrictive territory, or it's not going to stay there for a long time.
Right.
So it doesn't make a whole lot of sense when you look at it through the framework we do, which has a lot of academic and theoretical backing to it. And then you have to wonder, based on the jobs report, which we'll dig into later, does this blue line now keep going up? We've already seen expectations for rate hikes in March start to increase. Perhaps 0.5% is on the table. And then what if those cuts in the back half of this year come out of the market? And that could move that up again.
And so just a question on clock time. So as we move throughout the year here, our expectations right here as we sit here today for the next 2 quarters of GDP are for it to be negative. Mm-hmm. As we stay at this level of rates and clock time expires on the first 2 quarters of the year, mm-hmm. how does it impact the back 2 quarters of the year?
Yeah. If we're still in very restrictive policy, then the only real chance for strong economic growth in the back half of the year, it can only really happen in one of 2 ways. The first way would be economic growth in the first half of the year is so bad that just the quarter-over-quarter change has to be good. Or it turns out this green line is not the neutral rate of interest, and we're not even close to being in restrictive territory because the economic growth under the hood is so strong that actually even a Fed funds rate at 5% is stimulative. Mm-hmm. And restrictive territory is 6, 7, 8 because the Fed, but then you have to think the Fed's not even done hiking. They would have to raise the Fed funds rate even higher. And so that's bad things later. Mm-hmm. So, it doesn't end well.
Yeah. Yeah, I mean, they are clearly, as evidenced by our next graph on liquidity, continuing to pull liquidity out of the market. Mm-hmm.
And you can directly relate this peak in liquidity and the high liquidity that we saw through 2021 with the type of market leadership we're seeing today. Mm-hmm. That's why the market leadership that we're seeing today, in our view, is a lot of noise and not a lot of signal. This is going to be the worst liquidity environment we've ever seen for a little bit of time, even if the Fed stops hiking mm-hmm. in March, even if they cut in the back half of this year, we're still looking at very low growth rate in the money supply.
Yeah, we've never had this line so low here that we don't know the impact of how long it's going to take to get back to normal because this giant binge and purge process on liquidity mm-hmm. Has never been done before. We really don't have good data to figure out how this will play out,
right.
Whether it'll take a couple quarters or a couple of years.
Yep.
Because and just generally our market signals still indicate that liquidity signal to P, there's still a huge gap there.
Right.
And we should be priced on a liquidity basis, we should be around 36, 35 and a half mm-hmm. on the S&P.
Exactly right, yep.
All right, let's dive into the labor report and our graph here on the current status of the labor market.
And the January non-farm payrolls report was extremely strong. Good news is it indicates a very, very low probability that the U.S. economy is in a recession right now, which we'll speak to later. But the bad news is, you look at the number of jobs added, you look at how few unemployed people are in the population relative to the number of job openings, mm-hmm. which went up in December, and the fact that the unemployment rate went down, and you put it all together, and what you have is, by any measure, the tightest labor market at least since 1969. If you look at the unemployment rate at 3.4%, that is the lowest since 1969. And then if you look at unemployed persons per job opening, that is the lowest ever. So if you think about, over the long run, how is the Fed going to get inflation down towards 2% in a way that they feel confident they've defeated inflation? Well, prices, their central tendency are wages. And as long as companies are competing for labor at this magnitude, they're going to have to pay up for that labor, mm-hmm. which means there's going to be wage growth, which means inflation is going to be higher than the Fed wants, probably for longer than they want. So that's why this may be good news for the economy today and maybe first half of 2023, but it could mean the Fed has to go through another round of rate increases, just as we thought that they might be slowing or stopping here very shortly.
Mm-hmm. And so how does the tightness of the labor market correlate to companies' earnings expectations?
Mm-hmm. Yeah, and we can start to dig into that. If we go forward a couple slides here, we look at prices versus earnings. Well, what we've seen is we clearly had peak margins recently, and margins are starting to contract, and earnings are starting to come in. Mm-hmm. During the Q4 season that's currently underway, half of S&P 500 companies have reported, if the rest of the companies that need to report their Q4 earnings report in line with expectations, which is reasonable because the ones that have reported are basically reporting in line with expectations,
Right.
then we would have a negative 5.3% year-over-year earnings decline. That's our first year-over-year decline since Q3 2020. Also, expectations for Q1 are now negative, and expectations for the full year 2023 are barely positive. So wage growth is a big expense. It's going to continue to put pressure on margins, especially if economic growth is slowing, and it's going to result in earnings pressure until companies give. And what do they have to give? Well, they have to actually lay off workers.
Yeah, so you didn't state this, but earnings recession is a term used in a lot of instances. And explain the difference between an earnings recession and an economic recession, and what's, I guess, more impactful.
Earnings recessions happen more often than economic recessions. When there's an economic recession, there's almost always an earnings recession, but you can have an earnings recession without an economic recession. And basically all an earnings recession is 2 consecutive quarters of negative year-over-year EPS growth for, a basket of companies, the S&P or whatever the case may be. So economic recession is worse. These things typically happen at the same time, especially if the earnings recession causes companies to reduce headcount, which then results in an increase in the unemployment rate, which is the last thing to typically break down in the economy to create an economic recession.
So what will be interesting to watch is the weekly jobless claims and see how they're trending, right?
Yes, they are not trending up.
No.
At all. When we talked about job cuts last week, right? And we were like, there's a, job cuts announcements are clearly going up, but there's a different sort of narrative here where perhaps all the temporary workers that laid off, they just became full-time. And then all these job cuts that have been announced, all of those workers just rolled over and found a new job. And so they didn't even report initial jobless claims.
Right.
And that seems to be what happened. That plus it was everybody's New Year's resolution to get a job, I guess, in January. I mean, that's really the only explanation.
And some of those cuts haven't actually happened yet. They've
Right.
been announced, but they've not actually flowed into the numbers yet. So remains to be seen, but that'll be a good figure for us to keep our eyes on. And then if we spin back one chart to the inflation outlook, and just talk about the impact of unemployment on the path of inflation. Should it not go up? Unemployment not go up as fast as we think it might.
Right. So an input into our model that is very predictive 12 months out for core inflation is unemployed persons per job opening. And the fact that that is still very low is a reason why, if you look at our expectation for core CPI, at the end of the year, it's still running above 3.5%. Because if we want to get employment down faster, historically, what you need to do is soften the labor market. So it directly relates to our forecast, and that's the reason why at the end of this year we think we'll still be high and falling in terms of inflation.
And if we're at 3.6% at the end of the year, does the Fed say, hey, we're done, let's just ride it out? Or what's their response to 3.6?
Well, they could say, hey, if core CPI is 3.6, core PCE, which is what they look at, usually runs about 50 basis points lower than that. So say it's 3.1. Maybe maybe you should pause. But if core PCE is running at 3 and wages are still running at 4.5, how could you feel comfortable knowing and being a student of the 1970s and the monetary policy mistakes that were made, and the amount of misery in the U.S. economy during that time period? You would not be comfortable at that point cutting rates unless there actually was softness in the labor market.
And just sort of turning towards the Fed's activities on its balance sheet, what have they been doing to reduce the size of the balance sheet?
Yeah, they're continuing to move at $95 billion a month, reducing the size of the balance sheet, which, at other periods, during other periods of quantitative tightening, at this point we would have seen some issues in short-term funding markets. But the fact that the Fed now has these standing repo facilities, it basically takes care of all that. So that, once again, like we say all the time, good news, bad news. Good news is we haven't seen any real funding problems, but the bad news is the Fed's just going to keep reducing the size of their balance sheet. So bank reserves are going to continue to dwindle, and that just means less potential lending, which means the credit cycle is going to continue to slow, exacerbated by the inverted yield curve, which reinforces a low and falling economic growth forecast.
Yeah.
So,
all right, then let's just quickly give a recession update.
Seen composite recession probability come down a little bit last week and here year to date. And that's primarily if you look at the indicators, and you look at the short-term indicators, things like the S&P 500, that's our short medium term indicator. It's about 92% of its 52-week high, so that's gone from a red light to a yellow light. And then our shorter-term indicators are, a couple of them are based on the labor market, so PIGR and SOM, those are both green. You have the VIX has come down quite a bit year to date, so that's been green. So what that basically means is the market rally we've had and the clear strength of the labor market means the probability of a recession in the next 3 months is lower than it was to start the year. But if you look up to our longer term, medium term indicators, a lot of them are still red, especially the yield curve based ones are very red. And so there's still an elevated probability of a recession sort of 6 months and out.
And so since recessions are looked at in hindsight, there's a potential we could be in it right now. It just we won't know it until later in the year.
Right.
All right. Well, it's been an interesting week. We'll have an interesting week coming up next week. So we'll be back with more. In the meantime, if you have questions, just give us a call. We're happy to talk you through any of our forecasts.